definition of quality, has that changed in your mind? This is what it was 3 years ago or what it is now?
No, definition of quality has not changed. Categorization of quality today is in three buckets versus just one bucket previously. So the linear compounders are more like a 16 to 18% expected earnings growth. So 2 to 3 percentage points lower, more moderated than what they used to be. The allocation to this bucket consciously is being kept low. It's about 20 to 30%. I would not allocate more because I've got the second and the third bucket, which previously I didn't have. The second bucket I would say is where valuations are not likely to give you an upside, but there can be earnings surprises. And the third bucket, if I can have my way, the entire portfolio will be composed of this third bucket. There's positive expectation from the valuation, expectations baked around earnings or the fundamentals.
I know, given how much you care about delivering on clients' expectations, it must have been a very tough experience going through that. And at any stage, did you go through a period of self-doubt?
It has maybe not affected me because of the commitment I have to practicing this profession, which is the only reason why I'm doing this and I'll keep doing this. I know that as long as I'm committed over the longer term, I'll only learn from the mistakes and become better.
So hello and welcome to our latest episode on Marcellus Musings. Today I have with me a special guest. For those who don't know, Musings is all about me having conversations with some of my colleagues on their personal journey, on investing, on markets, on the economy in general. So today I have with me Rakshit Ranjan. I've known Rakshit for more than 20 years. That's pretty much 90% of my professional career. So we pretty much been through a lot in this time, learned a lot. Most importantly, we've had a lot of fun doing that together. I remember 2005 Clear Capital. It was a month after me joining Clear Capital, where Saurabh was already there. Rakshit walked in as our insurance analyst. And the thing that stood out, loud and clear was Rakshit's laughter. It's the most wholehearted laughter I've experienced, throughout my life. But that's what Rakshit is, in my view. As a formal introduction, most of you know him with his background as an engineer from IIT Delhi, and then later on joined us at Clear Capital as an insurance analyst on the sell side, and went on to author one of the best-selling books, Coffee Can Investing, alongside Saurabh, which in turn got translated into his investment philosophy, and now managing money for almost 9 years, 7 of which were at Marcellus. And I'm proud to be a co-founder along with Rakshit on Marcellus. Besides the introduction of here and now, I must say that the thing that stood out about Rakshit has been the extreme clarity of thought and the extreme focus on first principles based thinking. And he's not the type to look at, this is what great investors have done in the past and I should do the same. He's always figured out things himself, which is why I think the first thing that comes across strongly is his conviction. And in some ways, that's a basic tenet of successful investors, going through thick and thin, still staying committed to his philosophy is something that I respect a lot, and so do a whole host of our investors. And today at Rakshit's behest, I'm going to be wearing the hat of a client of Marcellus, which I am. I've been investor number 2 in CCP, and I've stayed invested, only adding to this. And I must say, yes, like most other clients of Marcellus, I'm also not happy. So I will make sure that disappointment comes across. But again, just to reiterate, this is upon Rakshit's request. Rakshit wanted me to wear a T-shirt and represent our client base, and ask him the toughest of tough questions. So Rakshit is prepared for it. Hopefully, all of you will take away, and hopefully I'll be able to do justice in terms of representing our clients' interest well. Now, before we get into the tougher part of the questions, Rakshit, why don't we start with a bit of background about yourself, which I haven't shared so far. going beyond the here and now. How was growing up like? What were those experiences? And I'm sure those experiences, um, mold our way of thinking about life in general, which in turn, as investors, we tend to get philosophical. That must have rubbed onto your philosophy of managing money as well. So why don't you give us an introduction about yourself beyond what we know?
Sure, Pramod. Thank you for a very generous introduction to begin with. You've done the good part about the last 20 years of working together. I'll try to address the more difficult part as we go along. In terms of uh, my upbringing, family background, and maybe some reflections that it might have on the style of investment. So I belong to Delhi in terms of my birthplace and the place where I was brought up. My parents, they're both doctors and they have worked in government jobs throughout their life. That sort of defined the sort of culture at home, which was more linear type of a learning, go to school, do well, behave well, get good marks. After school, college, after college, try to do a maybe post grad if possible, and then get a good job, so on and so forth. So the standard linear upbringing, I would say, of a middle class household. Um, it did instill in me, on the positive side, I would say, a sense of discipline. So I have always been very conscious of where not to cross the line on discipline in whichever forum I am in, so on and so forth. It did instill in me, I would also say, uh, uh, initially lack of a first principles approach, which you did appreciate, but it came a little later on, I would say, in my career, because initially I was just following instructions from school teachers to college teachers to thereafter, once I joined Clear Capital, even Saurabh, I was his associate. So those were the initial, I would say, reflections that it had on how I approached life. Um, there were a few negatives as well, as in, to admit it very loudly, one of the biggest regrets I've had in life is, till the time I started working with Saurabh and you at Clear Capital, I actually didn't appreciate the importance of reading books. So I had not read too many books, which sort of didn't open up my mind as much before I would say 2004, 2005, when I started working with you guys. So that those were the initial parts of the journey, but I would say a lot changed. A lot changed as I went along, as I looked around in the ecosystems where I was working. The first and the biggest change, I would say, was the kind of setups that we worked together, Pramod, in the UK, Clear Capital, then Execution Noble, and then even in Ambit. The core tenet of our offering to our clients was independence of research. And that brought, I would say, that germinated, or that seeded the sort of behavior of first principles in me. If I have to point out towards what was the one factor which started first principles thinking, and it also brought a lot of courage, as in, you don't have to be sort of afraid of non-consensual calls if that is what your mind thinks is right. That, I would say, changed the sort of reflections that I had from my past. Um, there were also many learnings around what is a quality business all about, which came from working on the UK insurance market, where I realized that, look, first and foremost, there might be analysts covering a quality business for 10, 15, 20 years. But if you do a deep dive research, you might still uncover some differentiated ways of looking at elements of quality which are not yet fully appreciated in the stock market. And that became a kind of a pattern where stock after stock, I would see either small or big attributes being underappreciated, even though the stock has been listed. And looking at, let's say, the share price trajectory, the number of people following it, or even valuations, it appears to be reasonably discovered, but there can be reasons for earning surprise. There can be reasons for surprise and capital allocation, so on and so forth. So that was again, when you connect first principles thinking with the courage of finding underappreciated aspects of a quality business. It sort of started a pattern of looking at businesses which I developed in the UK.
Hold that thought on quality and deep dive, because I want to double click on that. But before we get to the serious part of the podcast, I wanted our listeners to listen to how accidental was your entry into investing and sell side. And you narrated really hilariously, so I would rather let you do that. But what got you into investing and equity research in the first place?
So, I was working for this firm, ICICI Lombard, which is actually part of the CCP portfolio today. I was an employee there in the Mumbai office, working for the claims settlement team. At that time, it was called the Customer Services Group, Customer Services Team. And I was on a sort of international tour on behalf of ICICI Lombard to visit a client of ours, which incidentally happened to be Asian Paints. Asian Paints had 4 plants in the Middle East. I remember they were Egypt. It was a firm called SCIB, SCIB. Then Bahrain. There were 2 other countries, and the purpose of the visit was to just look at the risk factors being adhered to at the insured factory. So I did that, and on that journey, I received a couple of calls from my friend. That look, there's a firm called Clear Capital, which is trying to set up a franchise in insurance. It's a UK-based firm, and it's looking for a role. The candidature is something that you should apply for. That was all I heard from my friends. So my thinking was that, look, UK-based, not a bad idea. Insurance, maybe they are setting up an insurance company. Well, I can explore that. And they want to interview me. There's nothing for me to lose. So I just applied. I appeared for the job. Saurabh asked me in Mumbai, I remember, a few questions about logical reasoning. And I was like, well, this is good fun chatting with him and just trying to articulate how I think. I never thought an interview can just be about logical reasoning, nothing else. I ended the interview in the evening. Within 4 to 5 hours, the job offer landed in my inbox, and it was a significant hike in my salary compared to what it was at ICICI Lombard. So, to be very honest, I didn't even try to understand the specifics of the job, and I joined Clear Capital thinking that they are setting up an insurance arm in the UK, and I'm going to be part of it. Only once I joined, I realized, well, this is sell-side research. Research on insurance companies. They are not an insurance company, and I'll be actually based in Mumbai for the bulk of it. And the firm is based out of UK, but that doesn't mean I'm going to be part of the UK insurance industry as, let's say, claim settlement team or whatever. So that was the that was the way I started working at Clear Capital, and the journey has been well worth it.
So simply put, you had no idea you were going to do equity research till you landed inside the company.
Correct. That's right. I didn't know I was doing equity research when I landed inside the company.
Well, talk about happy accidents. You spent 20 very fruitful and hopefully fulfilling years in the profession for something that you accidentally landed up with. So
Correct.
so now let's go back to what you were talking about. I know most sell side research is anything but deep dive, right? We've seen plenty. Maybe sometime during our career, we've also done pretty superficial research. But I've seen you sort of migrate and pretty much swear by deep dive somewhere around 2012, 13. I remember when you started doing that consumer work. What changed that perspective? I'm sure you recognize the difference in the quality of the research. Not that at Clear Capital we were doing really superficial work, but compared to the sort of reports you ended up writing on Asian Paints or Marico or Berger Paints, Page Industries, it was a step change in terms of the depth. What changed that perspective? And I remember you saying, "This is all I want to do. If research is of not of this depth, I don't want to be a sell side analyst." So, what triggered that change?
It was a journey of 3, 4 years, I would say. So let me put it this way: 2005 to 2008 or nine, when I was doing UK insurance sector, I was largely following the frameworks laid down by Saurabh. I was just collecting information, putting into the frameworks, and insights were coming out basis how the dots would join due to those frameworks, and that was good. It worked to an extent, but then I also started realizing some pitfalls of that. And the biggest mistake that I made, I remember, in the UK research journey was a firm called Admiral Insurance. This was a motor insurer, which was very innovative in the way they would collect data from their customers to customize the products and services that they would offer. And they would come out with operating metrics, which were, they were something that the industry hadn't yet seen. They were growing at a pace, again, which nobody for the longest of time believed that was sustainable. What was a bit of a setback for me was I had collected all the information which some of my peers hadn't collected, but I hadn't joined the dots the way I should have, right? And when I look back sometime in 2009-10 at the missed opportunity there, I realized how close I was to sort of a eureka moment of understanding greatness in a very different way compared to what conventionally was being understood by for that business. So I think that left a massive mark in my on my mind. It redefined the way I would use information and join the dots to create insights. Fast track that into 2011, 12, 13 period when I started doing Indian equities, where Indian equities, particularly, I got to do consumer as a broader sector, discretionary staples, everything. Where it differed remarkably from my UK experience was that in the Indian equities, I realized every business model is very different from the other one. Understanding unit economics itself is, first of all, pretty refreshing because you might understand unit economics differently versus how the rest of the world has understood, and very rewarding. I remember the first couple of deep dives that I did were there was a firm called TTK Prestige, followed by Pidilite, followed by Jubilant Foodworks. These were the first 3 or 4 companies that I covered. The pattern I followed was primary data checks more than secondary. Don't sit in the office. Go become the customer of the firm first at multiple locations. Observe, join the dots, and then go back and do secondary research to understand how the unit economics is coming together on a P&L and balance sheet basis. And that
What
journey.
made you adopt that style? Because until then, there wasn't that much primary research. I know we used to speak to people who we could trace on LinkedIn. I'm sure you'd have done that with the insurance sector. But what made you get off your seats in the office and hit the streets of India and the markets of India?
I think there were two things. One, the habit of being courageous and reach out to people who might be very senior, more experienced, far more experienced than I was, and still just reach out to them and ask them to explain Unit Economics 101 about the business. That was one. The second was, I think, a little bit of helplessness as well, because to be very honest, when I came to India, it was after a gap of 6 years. I was looking at any I was working in India after a gap of 6 years in a way, because I had migrated to the UK in 2006-7. And as a result, there was a sense of helplessness that I don't understand where this country has progressed. The only way I can understand that is by being very, very close to the point of sale, because I'm in a B2C business, which is very different from my experience of covering UK insurance, which was a proper B2B, right? Because in the UK, I was covering Lloyd's of London insurers, and it was property and casualty, not really the retail insurance. So first time doing B2C, first time after a long gap doing Indian business understanding. That helplessness combined with the courage that, look, I've got nothing to lose. I'll just reach out to a former CEO and ask them, can you please tell me how your journey started, or how does this industry work really? So it was a combination of the two. Plus, I think the culture, which Saurabh, yourself, and everybody had set up at Ambit at that time and Clear Capital prior, that be an open-ended thinker. It's all right if you make mistakes, but don't sit in office. Just go out, push yourself harder and harder. So the independence of research piece and the culture that it brought about.
Fair enough. Yeah, so that led to Unusual Billionaires, which was then followed up with Coffee Can Investing, the book, and then the Coffee Can PMS that you launched whilst you were at Ambit. So just take us through that decision-making process of taking that deep dive research and using that to invest other people's money, right? Very big distinction when you invest your own money versus deciding to manage other people's money, and hence the launch of Coffee Can PMS. Just take us through that phase of your career.
Yeah, so I think it was somewhere around 2014. I still remember a couple of months before the Modi election win of May 2014, when by then I had covered Asian Paints and Page Industries and a variety of companies that eventually got featured into Unusual Billionaires as well. And I had sort of started to maybe get convinced by patterns existing across companies which represent sustainability of greatness. What happened subsequently was the Unusual Billionaires work progress. It forced me to more clearly identify those patterns, because what Unusual Billionaires did was, it in a way, to get quotations from ex-employees, I would spend hours and hours going through their journey with them, and then repeat with the second employee, with the third employee, with the fourth ex-employee, etc., for the same company. And it would sort of give me the overlapping patterns, whether the person was employed in the sales role or in the manufacturing role, or was let's say in the marketing role, so on and so forth. Those sort of consistency of decision making, which sustained greatness over several eras of the external environment, in a way drove the conviction that, look, these are companies which have lasted for several decades, whilst being great as businesses, If this is a sort of this is a journey that I can keep going along, if I can dig out even five more companies or three more companies every once in a while, every year, it's very refreshing. It's fulfilling. And this is all I want to do. That was the sort of decision 2014-15, which you rightly picked up. What I then realized was that the bulk of the sell side analyst's job is also about meeting client objectives, which can be very diverse. Which means that you might be covering, let's say, page industries, but when you talk to certain set of clients whose philosophy is more oriented towards taking short-term holding periods in their decision making, versus others who might want to hold a company for 10 years, 15 years, they might have different perspectives. You still have to talk about the same company to them. And hence, you might have to talk using their perspectives. Now, there are hundreds of ways of making money in the stock market. There's no right or wrong way. And hence, all these diverse ways of investing money coexist. And a sell-side analyst has to cater to all. What I realized was that my joys of talking about longevity, sustainability, or greatness, they cater to a subset which, unfortunately, at that time at least, was a relative minority compared to the other set of clients who wanted to know what's going to happen next quarter, or the quarter after that, what's going to happen next 6 months, 12 months. Don't tell me about the last 20 years, and don't hypothesize for the next 10 years. I'm not interested in that. So that distinction between the demand and supply of my work, it created a kind of a disconnect, which was in a way my problem. The supply was me. Demand has all sorts of colors, and I wanted to just cater to the style of investing that I had started to enjoy more. Once I explored the variety of options that I had in terms of how to pursue this style of research, I realized that it's actually best if I do it with capital, which is very patient, and the most patient way of doing that would be to begin with your own capital, your family and friends' capital, so on and so forth, because they will be far more patient. You might be able to find greater alignment in terms of investment objectives, and hence started the thought process that I can't do personal money investing or friends, family money investing whilst being a sell-side analyst. Can I actually think of a switch in career to an avatar where I can do this far more sustainably? And this took, I would say, about a year or so as a thought process transition in my mind, after which I decided that I'll be happier doing this in a buy-side avatar. And that's when I was fortunate, I was lucky that there was an opening in Ambit's asset management, which had come up because the erstwhile team of fund managers had actually just left. And it became a little bit of a coincidence. I reached out to Saurabh and got to do Ambit's Coffee Can PMS in early 2017. So that's how the transition worked out.
Great, fantastic. So 2017, Coffee Can PMS was launched, did really well. 2018, December, we launched Marcellus CCP. We had great performance over 19, 20, 21. So 5 years of sustained strong performance for a portfolio is phenomenal. And from what I understood in terms of your philosophy, like I said, I'm paraphrasing it as if I'm a client, is the philosophy was about buying businesses which have greatness embedded in them and sustainable at that for several periods of time. Right. So you're not the first fund manager to underperform or go through that phase. Plenty of legendary investors have been through that phase, but we're trying to understand what you made out of that phase. Just talk us through that, and perhaps you could end with maybe we can take on the lessons from that later on. But just what in your view, if you were to assess that period, how would it be like?
Yeah. No, I mean, I'm nowhere close to being compared with legendary fund managers. But what changed? I would say the change as a catalyst was external, which exposed my weaknesses that I was so far able to get away with. So the change in the external environment actually was, in a way, COVID brought a massive change to the external environment. There were parts of it, and let me first call out the weakness that I was sitting on. The weakness was that ever since I had started covering Indian equities, 2011, which was sort of 10, 11 years prior to that, there was only one style which had worked in the equity markets, which was quality. I mean, there were a few sub phases where quality didn't work during those 10 years, but they were short lived. For the longest part, quality worked pretty well. Most importantly, within that, the sectoral spread across quality which worked was very narrow, right? Largely consumption, financials, and a little bit of maybe IT, maybe somewhat pharma. That's it, really, right? Two or three sectors were constituting the bulk of the quality universe. And hence, in a way, I had become comfortable, which was the weakness. I had become comfortable knowing only two or three sectors reasonably well, and also a little ignorant that if things change in the external environment, they can actually be a radical and a structural change rather than just a transient and a temporary change, right? So the way it hit was there were, broadly speaking, two phenomenon at the moment that I can recollect, in a way I can classify, that hit hard adversely the performance. Phenomenon number one was that there was a lot of highly correlated risk that I was sitting with in the portfolio, right? To begin with, it was consumption and financials largely, and hence it was far more B2C. Because it was far more B2C when COVID hit, all of these companies, because they were great, they benefited from the crisis through their actions. And quite interestingly, despite being slightly differently oriented in their products and services versus each other, they had common factors of success in 2020-21 through COVID. So I'll give you a simple example. Maybe just think about it like this: you've got a Divi's lab as an exporter of drugs to the Western world. You've got Page Industries, which sells undergarments. You've got, let's say, a Dr. Lal Path Labs, which is a diagnostic firm, healthcare. And you've got Asian Paints, which is related to, let's say, home building materials. Interestingly, COVID hit all four of them first very positively and then very negatively, right? So Molnupiravir, it vanished immediately after 2000, the Omicron wave, whatever that name was, January 2022 COVID wave, followed by RT-PCR tests of Dr. Lal, followed by work from home related, let's say, the
Athleisure wear, yeah.
Athleisure wear of Page Industries,
Yeah.
followed by a massive organized to unorganized shift in the paint industry after a couple of years of massive unorganized to organized shift that Asian Paints enjoyed from, and a lot of preponement of demand of home renovations and all, which sort of clubbed all the repainting cycles and created a wake effect right? A lull effect in 2023-24. All of this happened, I would say, 6 months apart from each other. It was not the same quarter where all of it happened. And interestingly, uh, uh, not related to COVID, but even the regulatory environment for the banks and lenders in general, it underwent a transition, which meant all the three large lenders, which was a massive weight and a concentrated portfolio, Bajaj Finance, Kotak, HDFC Bank, they all got slapped on their products with bans from RBI. They all got curtailed on their growth rates in some ways or the other for a couple of years. So a lot happened altogether to the fundamentals of these companies, right? The weakness was not just limited to correlated risks, which was the first big weakness. The second piece of weakness was that even in my wider coverage universe, I hadn't been exploring newer industries that were actually coming out from an inefficient unit economics to transition into very efficient unit economics, partly thanks to COVID and the changing consumer habits or customer habits, client habits, or the external environment, or partly maybe in some cases turnarounds, right? So the easiest one, I mean, it's easy in hindsight, and hence I'm using the word easy. The easiest one is I missed out ICICI Bank turnaround, right? Which could have offset the HDFC Bank sort of stagnation of fundamentals and share prices in a reasonable way. But that's the easy one to pick up. The harder ones, which I should have picked up had I been sort of working on an overdrive to hunt for newer great businesses getting created. So think about it. Large format retail and Trent was an outcome of that. Hotels and Indian Hotels is an outcome of that. Hospitals, and today Narayana is in the portfolio, it's an outcome of that, and many other hospitals. These are three real estate oriented. When I say real estate, I mean capital employed includes a large part of real estate, whether leased or bought. These are three businesses which never made returns on capital employed prior to COVID, either because the demand hadn't yet crossed a critical mass, or their learning journeys, learning curves hadn't yet reached the inflection point after which it would become high quality unit economics, or maybe one or two other supply side factors as well. All three of them, they came out of their low ROCE mode, if I were to summarize it like that, into unit economics which are consistently high ROCE and scalable, right? And I missed this evolution despite being a B2C oriented analyst previously, and these are all three B2C, right? And despite being pretty close to consumer as a sector in my fund, in my learning journeys, etc. So it was a combination of these two weaknesses, correlated risks in the portfolio, and lack of understanding of newer business opportunities that came up because of the changes in the outside world. When you join the two together, what ended up happening was, I mean, all of these existing portfolio companies, they massively benefited from the crisis in 2020-21. And the narrowness of the market in the prior 10 years led to their share prices shooting through the roof. So valuations for them became significantly more expensive than what perhaps was going to be delivered in their fundamentals, basically the expectation that got baked into the valuations, right? So when you look at it like that, what I lacked as a result was the agility to switch out of either, you can say, highly valued companies in some cases, or taking, let's say, the HDFC Bank, Kotak as examples, the moderating growth rate of great companies, and replacing either high valuation or moderating growth rates with substitutes that can actually be high growth and I would say expectations not fully baking in what the business is going to deliver, right? So that's where I would I would say 2022 ended up being the period, and it took a while to sort of fix these weaknesses, come out, make changes to the portfolio. So somewhere in the second half of 2023, that journey to rectify the problems, to fix the problems, it started. I won't say all of the weak absolute returns or underperformance of 2021 and 2022 and 23 could have been fully avoided had I not had these weaknesses. But there would have been a significant cushion,
Yeah, of course. I mean, no investment philosophy or style or manager will deliver outperformance every single year. I think, as acknowledged, I don't think anybody's expecting. And I think that 2010 to 2020 period being a very unique period in Indian economic history, which was a very narrow economy with only a handful of sectors working, which in turn translated into a very narrow market with a handful of stocks working. Naturally, in that sort of an environment, quality tends to outperform. It was a fairly prolonged period of outperformance for quality. Point taken, if you started your career in Indian equities in 2020 and getting influenced by that period is absolutely human and understandable. I would say the mistakes of omission that you highlighted are also understandable, right? You're not going to pick up every winner out there. Let's be realistic. I think it was Howard Marks or someone who famously said, "You don't have to kiss all the girls in the party," right? It's about avoiding the mistakes of commission, which I want to sort of double click on. You alluded to valuations. I remember us having debates on valuations. You came out with a beautiful framework, which on paper, thanks to this great firm called Microsoft, has invented Excel, which we could prove to ourselves that if a business can compound its free cash flows at 20% for 20 years, its fair value should be 200 times PE. And therefore, if I'm buying something at 70 times PE, I'm buying it dirt cheap. Somehow that didn't translate. And I remember there were a lot of voices amongst our clients as well, amongst well-wishers in the industry, other fund managers, and of course, social media. Amidst all the noise, the message that was coming out was we were doing BOP, buy at any price. Whereas the truth was internally, you had this justification for yourself. You were doing valuation, you were doing a DCF, you were saying that businesses that compound free cash flows at 20% for 20 years can be worth 200 times. However, how do we know that it's going to compound at 20% for 20 years? Many of those very businesses barely have compounded in the last 2-3 years, right? Including the legendary Asian Paints. So the point was, given that the future is inherently probabilistic and unforeseeable, with what confidence can we bake in those assumptions, and hence the concept of margin of safety to let us keep room for error. Had this valuation been more clearer, perhaps that would have forced you to look elsewhere in the sort of sectors that you talked about, and maybe reduced mistakes of omission as well. If you were to dial back in time, go back into 2020, when you're looking at Asian Paints inching towards 70 times earnings, or Bajaj Finance at 7 times price to book, HDFC Bank at 4 times price to book, and still your repertoire of knowledge about other sectors, other businesses was very limited. Would you do anything differently? And if yes, how?
Yeah, so I'd say obviously it becomes, would I do something differently? Had I had a repertoire of options, the answer is a longer one and an easier one. But had I not had a coverage universe beyond what I did, what would I have done? I think buying stocks into a portfolio is one part of fund management. Managing stocks within the portfolio is also a massive skill set which fund managers learn, and I have learned my way. What would I have done? Well, first and foremost, appreciating what was baked into expectations at a certain price, and then as risks appear on the horizon, taking far more aggressive position sizing changes within the portfolio, even if you don't change the list of stocks in the portfolio, would have provided a lot of cushion. So I'll actually give some direct examples. So of all the stocks that we had in the portfolio, Divi's Laboratory was the best executed stock, where despite the fact that we stayed invested in it at low as well as high valuations, we made a very high rate of return on the investment. And what we did there was 2020 January, we entered with a sort of 3 or 4% position size. It on its own went up to 6% by middle of 21, and we aggressively trimmed it back to 3% by September, October 21. And then COVID went away, the share price halved, and we took the position size back to 6 or 7%.
So just dwell a little bit on, just tell us, why did you trim Divi's down aggressively?
Yeah, that was far more lucky than I would say.
I was hoping you'll say it was too expensive. We don't buy at any price.
No, if I had a logic, that logic would have applied at scale across the portfolio. I didn't have a proper, I would say, process towards that. It was more luck, because what had happened was we had started to quantify internally various attributes of quality. You might remember the longevity framework, and there were the 3 scores that we started to give in sometime in early 2021. And basis those 3 scores, because we didn't understand the institutionalization of Divi's, which was the luck part, right? Because today we understand it. Understand it. At that time, we were worried about why it is all a family-oriented senior management team. Nobody outside the family is easy to be found in the senior ranks. Is this a Lala ki dukaan, or is this a institution? Data, historical metrics suggest it's an institution, but we can't see that basis the softer aspects. And Divi's is a pretty opaque business in that regard. So just being conservative on something we didn't understand on the softer aspects, we decided to trim the position aggressively. So it wasn't because of valuation, it happened to be luck, as I mentioned. And once it fell, interestingly, by then we had started to appreciate many more positives that we didn't appreciate in 2021 about Divi's. And that led to the courage of more than doubling the position size, because it had fallen after we had trimmed it to 3%, and then we ramped it up to 6%. And that worked out really well. The share price since then, I think, has almost doubled, if I'm not wrong. And we have had to actually trim to contain it in terms of the position size, because it ran too fast too soon. So that piece, had I been far more aware of risks on the horizon versus expectations baked into the current valuations, I would have maybe done that at scale. What I did do, which was partly the solution but not the full, was when a Dr. Lal Path Labs crashed, we doubled down on it. When a Bajaj Finance dropped, we loaded more. We didn't double down really, but yeah, it fell a bit, and we increased our allocation a bit more on it, etc. So we did do that, but even that, I would say, we did it on 3 or 4 stocks, not on the entire portfolio. And we didn't do it on Page Industries, for instance. We didn't increase Page after it fell. We should have, in hindsight, obviously. Had we done that, we would have made a few more basis points for our clients. So that is, I would say, the answer to what we should have done without having had a wider coverage universe, manage position sizing in the portfolio. Because to be honest, Pramod, it's uh, uh, it's it's clear to me now, was at that time as well, that nothing lasts forever. And even when we wrote Coffee Can Investing, when we wrote Unusual Billionaires, uh, it's not that the survival rate was 100% on those quality businesses. So we knew that nothing lasts forever. But at the same time, as long as you can foresee reasonable elements of quality being present in a business, and the longevity that you can attach with it at a point in time, um, doing a DCF will certainly give you a fair value PE multiple higher than the 50, 60, 70 times at which some of these stocks were trading at that time. What we failed to realize was that, look, first and foremost, that 100 times or 150 times PE multiple fair value comes from a 10 or 20-year holding period, right? It doesn't come from a 2 or 3-year holding period. Over a 2 or 3-year holding period, as risks emerge on the horizon and get baked into expectations, the DCF undergoes a massive downward correction, right? And then suddenly, till the time the risks weren't there, the fair value might have been 100 or 150 times PE. But the moment the risks start to play out even a little bit, the fair value drops precipitously, right? Very sharply. And that piece is the expectations investing in a way, rather than just saying, look, the fair value is X and it's trading at X divided by 2, and hence it's cheap. It also needs to appreciate that, look, for X to be delivered, none of the risks should play out. But now some risks are appearing on the horizon, which are not part of the valuation currently being given to the stock, perhaps. Even though it appeared cheap, it doesn't appear cheap anymore, right? And that starts a trail.
Isn't the real world much like that? Like they say, the
Correct.
biggest risks are the ones that are unforeseen. So by definition, the risks will appear to you on the horizon, by which time it's already too late, which is what makes people like Buffett and Graham talk about margin of safety, which is catering to that unforeseen risk.
Correct.
Given the probabilistic nature of the world in general, building in that margin of safety in terms of valuations. Now, having recognized these shortcomings and you begun to address, it's not easy. First of all, hats off to you for being candid and honest about recognizing those shortcomings. But unfortunately, we are in a profession where we don't have a choice. The market is a humbler. We'll need to course correct. We owe it to our clients who've trusted us with their hard-earned money. So we are anyway forced to change. But that period of change can also be very volatile, right? It's not like the switch you say, okay, now I acknowledge the mistakes. I'm going to turn on this switch. From here on, everything will be all right. That phase is not just a point in time, it is a phase. In that phase, we've seen, and in fact, I'm representing a lot of our clients, that there's been a lot of chopping and changing in the portfolio. Arguably, some of those stocks, you talked about not doubling down on page or doubling up on page. Even HDFC Bank, we haven't played the full recovery. Position sizing has been smaller. Instead, we've gone towards a tube. Trend played out really well, or an Escorts or a CMS. This phase of change itself has been a little volatile. And I would say if I were a Coffee Can fan or a CCP fan sitting outside, it'll be very confusing. What is this new CCP? I would have been comfortable had you held on to an HDFC Bank, Kotak, Bajaj. Some of them worked out, some of them Asian perhaps holding on to it hasn't worked out. But bringing in these new changes, which is not clear to me that these are CCP type stocks, is that sort of work in progress in your mind? That having acknowledged the shortcomings, you're trying to work upon them, perhaps haven't reached a stage where at least you're clear that this is the new CCP or CCP 2.0. When I say work in progress, it'll always be work in progress. I'm not saying that this pretty much you will end up with the holy grail. But by and large, are you stable in terms of your thinking on what is your philosophy as it stands today, as opposed to say 3 years ago?
Yes, no, the stability part is unquestioned. As in, I'm stable in my mind, but as you said, the philosophy, the way it gets executed over a period of time, will always be an evolution for every fund manager. Should always be an evolution, and hence the work in progress will always be there. What happened in terms of the the chopping and all the churn in the portfolio last year? The realization was very clear that, look, this is the problem, that the external world has changed. It's not a transient change. It's a more of a sustainable, structural, call it the new external world. We need to catch up, and as we catch up, we can do it in two ways. One is organic over a period of, let's say, 4, 5, 6 years, or the second one is approach a 70-80% hit rate, which is very high. 60-70% is also very high in fund management. You'll not get all the calls wrong, but let's make the change to the new normal, using the resources in terms of the research team, their efforts, the work that they're doing, which all happened in 2024. Now, when you assess the impact of that change in terms of whether the changes worked out or not versus the stocks that we exited, in some cases, assessing that impact over a 12-month period is also a bit too short a time frame. 12-month period will always have a lot of volatility. So on the one hand, you will
Well,
have.
just to stop you, not talking so much about the performance of these stocks or the portfolio. It's in terms of definition of quality. Has that changed in your mind, basis what it was 3 years ago or what it is now?
No, definition of quality has not changed. Categorization of quality, I would say today is in three buckets versus just one bucket previously. So today, the way I look at stocks within the quality universe, I classify them either as sort of linear compounders, which is the entire piece that used to exist in my mind till 3 years ago, where valuations are not expected to give you an upside. Earnings growth is going to drive the share prices almost entirely, right? Till 3 years ago, the bulk of the stocks in this bucket, in my expectations, were going to compound at closer to 18 to 20% in earnings. And hence, there was the derived expected outcome of the portfolio, because that was the bucket I was picking up from. Today, the linear compounders, I would say, are more like a 16 to 18% expected earnings growth, so 2 to 3 percentage points lower, more moderated than what they used to be. But that is one part of the bucket. The allocation to this bucket consciously is being kept low. It's about 20 to 30%. I would not allocate more because I've got the second and the third bucket, which previously I didn't have in the way I look at quality. The second bucket, I would say, is where valuations are not likely to give you an upside, but there can be earnings surprises, as in these might be companies which are trading at 40, 50, 60 times price to earnings. But by understanding their businesses, I can see some capital allocation decisions taken over the last 2 to 5 years, which are approaching their inflection point of bearing fruit, that is not baked into the expectations. And once that does get baked in a way, the PE multiples E becomes much bigger and the PE becomes smaller than what it appears to be. And hence, there's a positive surprise. You can look at it either via the PE with the denominator becoming bigger, or you can just look at it as a higher growth company than what the market otherwise expects. So that's the second bucket. And the third bucket, I would say, is where if I if I can have my way, the entire portfolio will be composed of this third bucket, which is there's positive expectation from the valuation and positive expectation from expectations baked around earnings or the fundamentals, right? This would be businesses typically which either have had a rough 2 3 year phase, and hence their valuations have taken a massive beating. And my belief is that the market doesn't recognize them as quality anymore, but it is quality, and I would say Tube falls into that bracket. Or this could be, let's say, where till a year ago Narayana was, or today a CMS Info is, where valuations haven't yet recognized incremental capital allocation decisions that have started to bear some fruit, will become bigger and bigger in the overall scheme of things. And we are waiting for that. None of these calls will be 100% correct. It's all probabilistic. But as long as I can have larger allocations in the second and the third bucket than the first, in the new external environment where the linear compounders are not going to deliver 20% earnings compounding without risk for a reasonably long period of time. I think nothing has changed in terms of the definition of the quality, but a lot has changed in terms of stock selection and thereafter position sizing as the journey progresses.
So I see two or three changes if I were to put myself in our client's shoes. One is a little more openness to looking at turnarounds of sorts, right? I talked about, say, CMS has had a few years of rough patch, but you're convinced about the underlying fundamentals of the business and you're happy to play out the recovery. You will be richly rewarded if the recovery plays out because valuations are significantly on the lower side. The second is an acknowledgement that some of these linear compounders were never meant to grow as fast as we thought. I remember I used to do this slide where you used to show that if you buy a company with earnings growth 25%, hold on to it for 10 years, even if they're multiple halves in that 10-year period, you knock off 7 percentage points and you make an 18% return. Now you're saying that that 25 is not 25, that itself is down to 15, 16. And therefore, I can't afford to take that 7% de-rating hit. And the third, perhaps not a change, is in the case of the likes of Tube, you believe that there is a lot that is underappreciated by the market. By the way, Tube is not a turnaround story because the market is paying 60. I don't know what the multiple is, 60 times with almost more than half its value coming from CG Power, which is at, I don't know, 90 times earnings. So the market is clearly paying a lot of premium for that earnings. But you reckon even that premium is not fully reflecting Tube. Now, that comes, that brings the question or the allegation that's often thrown at us. These guys are arrogant. They think they know better in terms of how the future is going to pan out. Now, we've discussed this. I think it was Cliff Asness who made the point in a recent podcast that active investing is an act of arrogance to begin with. If this data suggests that 90% of fund managers fail to beat the index and you choose to become an active manager, you have demonstrated enough arrogance in that one act itself. Now, having demonstrated that arrogance, what's wrong in that behavior? That, I think I have seen something that the world hasn't seen, and therefore I'll make money from that.
Yeah, no, I totally agree with you that conviction is what should drive decision making, and conviction can be perceived either as arrogance, which has a negative connotation to it, or it can be perceived as, I don't know, differentiated courage, which has a positive connotation to it. Right. Be that as it may, I would say what uh, what what is a generic phenomenon in fund management and does apply here in terms of CCP is that uh, the the decisions made in the fund are representative of the way the fund manager thinks. Now, if the fund manager is arrogant or convinced or uh, whatever other adjectives you use, it will reflect in the decisions that the fund manager makes. In this case, given how I have approached research first and then decision making on top of research, which then transcends into the broader philosophy, the portfolio construction, and 20 more attributes beyond just doing research, which that then come into the portfolio construction piece. I derive a lot of my personal energy from taking decisions based on high conviction, right? I do not feel at that point that I can't be wrong. I do not feel that others are wrong necessarily. But what I do feel is that there is a certain, I mean, at a point of making the decision, I make it because I believe that there is a more than 50% probability for sure, maybe 70 to 80% probability, which is actually a very high number. And only a 30, 40-year journey will prove whether I'm 51 in terms of probability of success or 60 or what. But it's that conviction that, look, there's a high likelihood that I have understood this business well enough. At the same time, a high likelihood that when my understanding of the business gets delivered upon, close to that at least, there will be a positive surprise in either the appreciation of the business as being quality, sustainable, growth in fundamentals, or various other attributes. That's the element of decision making that goes into the conviction. Now, there are many ways in which you can actually read the outcomes of this. To begin with, it's not just active fund management, it's active fund management with a highly concentrated portfolio, which needs even more conviction slash arrogance slash differentiation, whatever you call it, within the concentrated portfolio, long holding periods, which means that not every small risk appearing on the horizon will lead to me exiting from the stock, right? And in fact, doubling down as part of the behavior when the share price falls, right? That is part of what do you call portfolio execution, which is also a part of the personality and then the behavior. Because I mean, there's a very nice book called it's on portfolio execution, which I read, written by a UK based fund manager, and it talks about once you've selected a stock into the portfolio, either the stock does well or it does badly. When it does badly, you can either exit from it, which is all right. You can double down into it, which is also all right. But sitting like a rabbit and doing nothing is doing injustice to being empowered to take decision on behalf of the money that you're managing, the clients you're managing. Similarly, when the stock goes up, you can either exit it completely because it has had its full run, or you can trim it so that you are containing the risks. But just sitting and doing nothing, again, there as well, is taking a risk which can go out of proportions, so on and so forth. So I think when a stock would fall, I would double down. When I would buy into it, I get more convinced. I will take the position size up to a very large extent. These are all elements of portfolio execution which come out of a personality, and the kind of personality that I have. I want to connect my conviction with portfolio construction. which leads to some of these decisions. When they work, the perception gets built on in a positive way, and it did till 2021, I would say, which is obviously not sustainable, but it got built. And when it doesn't work, it gets perceived as arrogance. So, I
Right.
mean,
No, I mean, look, it's an impossible trade-off. It's an impossible trade-off between humility and conviction. Both are necessary traits in a successful fund manager, but there's a very thin line separating the two. Often, if you have too much of conviction, it can be bordering on arrogance, which questions the humility. If you keep questioning yourself all the time, I might be wrong, then you will never have the conviction to double down on stocks which have fallen for non-fundamental reasons. So it is the nature of the beast you signed up to. You'll have to keep grappling with that. Having said that, I wanted to bring one aspect about the concentrated portfolio, not necessarily concentrated portfolio, more in terms of um, assessing risks on the horizon. You talked about having done the in-depth research. I feel comfortable, convinced that I've seen all possible risks. In reality, like we discussed, the future is inherently unpredictable. And worse, on top of that, we are humans. We have our own cognitive biases. While in depth research is good, but often when we are doing in depth research, we might be trying to look for data which confirms our thesis, confirmation bias. Is that something that you've experienced through this period? If yes, what have you done to acknowledge that and be aware that you could be falling into this confirmation bias because of such in-depth research you do? I mean, if I were to do such in-depth research, I would think I know this company better than anybody else, and nothing could happen with this company that I can't predict.
yeah, no. See, first and foremost, I mean, you said I have to grapple with it. I enjoy this. Okay, it's not about grappling with it. It's a profession I have chosen not because of any obligation. I'm passionate about it, and I just enjoy going through all phases of ups and downs. In terms of confirmation bias, it comes very often, right? And again, my solution to it is substitutes available. If available as better substitutes versus what I have in the portfolio, it's easier to kill the confirmation bias. I'll again keep going back to the weakness that I recognized I had. Think of it like this. About a year ago, I dramatically reduced allocation to Titan in my portfolio, not because Titan fell in terms of quality as a franchise. No new information gave me anything negative about the current business of Titan. Lab-grown diamonds was a risk that I saw emerge on the horizon, which can actually, in a very short period of time, take away the unit economics of Titan if it plays out. It was reasonably easy for me to make the decision of trimming from sort of 10% allocation to 1%, and now it's actually out of the portfolio. Same with Bajaj Finance. It was one of the largest stocks, 9 or 10% allocation, dropped down to 1. When I saw after the MFI investor, then the MFI borrower, then the personal loan borrower, different classes of borrowers in the broader lending industry undergoing stress, and Bajaj Finance being a leveraged play on unsecured lending is at the receiving end if that risk plays out into Bajaj's books as well, or at least in the perception of Bajaj's books, and hence why wait? Let's take a massive cut on the position. Now, Titan, Bajaj, in hindsight, we'll find out only in 2030 whether this call was right or wrong. But it was easy for me to take this call because I had substitutes available. If I don't have substitutes available, the confirmation bias is something that you might not recognize so clearly, and you might not even have a solution for it, even though you recognized it, and you might take only a partial knock off on the position because of the confirmation bias. So I don't think the confirmation bias is new to the decision making that I'm doing. I think what is new is the ease with which I'm willing to bring agility into the portfolio and replace it with something else, because there'll be a wider variety of alternatives where research has been done. My conviction is there, and making that relative call that once something looks risky, what else looks less risky compared to that? Can it be a substitute? This is something which I think helps kill the confirmation bias, even though the success rate on some of the exits might be low. But as long as the substitutes they work out with a reasonable success rate, the success rate on this churn or the decision will be high enough.
Fair enough. So let's talk about the impact of this period of underperformance on you individually. I know, given how much you care about delivering on clients' expectations, it must have been a very tough experience going through that. And at any stage, did you go through a period of self-doubt, whether actually cut out to deliver on this? Did you feel the burden of clients' expectations that, I've taken, people have trusted me with this, I need to deliver?
Honestly, not at all. Which might be a negative. It might be negative. I mean, you might call me arrogant for saying that I never had self-doubt, but I didn't. I don't know why. Maybe because I could see what needed to be fixed more clearer than what people around me could see. Maybe because I'm deeply committed in whatever I do, and here in this case, I'm committed to become better and better at this profession for 20, 30 years. I am not doing this for any salary or any monetary benefits, to be very honest. I mean, those are important for anybody's eventual, well, financial freedom is important for happiness, but it's not the most important thing. Certainly not for me. So if that leads to either pressure around, let's say, the P&L of Marcellus or the balance sheet of Marcellus, or reputational impact on either, I don't know, social media, or even what colleagues or clients or distributors, channel partners might be giving me as a feedback, it has maybe not affected me because of the commitment I have to practicing this profession, which is the only reason why I'm doing this, and I'll keep doing this. I'm not so worried about short-term impact that my mistakes might have on a portfolio or of a client, because I know that as long as I'm committed over the longer term, I'll only learn from the mistakes and become better. I mean, what doesn't kill you only makes you stronger applies the best in fund management. So no, I never had any self-doubt. It did have an impact initially. Initially, there was a little bit of, I would say, frustration, irritation in terms of I have understood the problem through my lens, as in the way I explained that it was more because of lack of width of the portfolio and valuation and let's say concentrated portfolio or the large position sizing and various other things were just outcomes. I don't think valuation was a starting point. I don't think a concentrated portfolio was a starting point of the problem. I think the starting point of the problem was something very different. When I have seen lack of alignment in my understanding of what the problem was with the outside world's understanding of what the problem was, and outside world is everybody other than me, there was initially frustration, irritation, and over a period of time, there was acceptance that, look, I know my decisions better than anyone else does. When I look back, I know my efforts to fix my decisions going forward based on the learnings in the past better than anybody else can. What the world will always perhaps look at me is via outcomes. And today, in hindsight, outcomes are valuations. Outcomes are maybe sticking for too long with a particular position. Outcomes are sectoral concentration, etc. But they were all outcomes of something very foundational, which I have recognized and fixed. And hence, I would say after the initial phase of frustration and irritation came the phase of acknowledgement, acceptance that look, if I'm in this for the long haul, I shouldn't be worried about what happens in the short run. And that has sort of helped me stay
fantastic.
happy.
I mean, that's what, from what I've known, very little I know about great fund managers. This is a very, very important trait which you possess, which is in rarity, and I'm pretty confident you'll come out of it stronger, as we are already witnessing. Last piece I wanted to touch upon was we've discussed this internally. In some sense, we erred in terms of communication as well, right? For what a concentrated portfolio was meant to do. The biggest misnomer became the name of the fund itself, consistent compounders, where in our mind, the consistent compounding was meant to be with fundamentals and earnings, but we somehow miscommunicated. We'll have to take the onus, particularly I'll have to take responsibility for that. That somehow gave the impression that these stocks or this portfolio will consistently outperform, or at least consistently give very healthy absolute returns. Now, erase all of that. If you were to start today, or if you were to speak to a new prospective investor in CCP, how would you set expectations? What should investors expect? What kind of an investor do you want? How, what do they expect in their journey? Let's say everybody is happy to stay invested for at least 5 years. Let's not talk about 10 years and multi-decades, say 5 years.
Right. So to begin with, I won't engage into a discussion which tries to answer the question: if I stay around for 5 years in your fund, what kind of a return will you deliver? Although
not just return, the whole experience, the whole works. How will be my journey?
Correct. That's what I'm saying. So I would try to set expectations more about the philosophy and the inputs that go into it, and hence the expected output, rather than just trying to set expectations around the output. Right, because then if you do it more via the input, it becomes easier to get alignment of objectives to begin with, because the end result might be that 2 months before the 5-year time period ends, India might be at a massive war with Pakistan and the stock market might be down 50%, or maybe the defense stocks might be up 100% and I won't have them, and my portfolio might be down 50%, right? So absolute and relative, it's a bad situation to be. So rather than talk only about the outcome, first and foremost, I would try to discuss only the philosophy and the attributes within it. Secondly, I think I would.
Isn't that exactly what we did? I mean, initially we talked about buying great companies and staying invested forever. I don't think we ever talked about 27% returns, which you ended up giving in the first 3 years. So the output, in some ways, we were also surprised, right? It was not like we gunned for 27%.
No, I'll tell you, Pramod, where I think there was a slight difference. So we tried to certainly do the philosophy, articulation, and then the rest of the product. But there were a few areas where it was just the outcome being discussed, which perhaps created the miscommunication. So to begin with, I think Coffee Can Investing is an outcome-oriented book, right? In Coffee Can Investing, what we're showing is you hold a portfolio for 10 years and what kind of an outcome it gives, right? What we are not discussing about is within that 10-year period, what kind of a journey does the investor go through? Can the year 5 be very, very volatile, stressful, decimating in terms of the portfolio value, uh, we haven't zoomed into it, right? So that was one piece of, I would say, the problem, where people linked back the sort of coffee can investing conclusions and expected the 10-year outcome to be there in every relatively smaller subset as well of 3 years, 5 years, etc. That was one problem. The second problem was, I think, we talked a lot about specific stocks with their specific attributes of quality. That, I don't know, maybe that also contributed to the confirmation bias becoming bigger and bigger in my mind, as we kept articulating greatness of a particular company, and then when that company starts undergoing moderation in fundamentals, it probably psychologically might become harder to take corrective actions on those stocks. But also, I think the discussion, once it went into specific 2 or 3 stocks, it doesn't revolve so much around the philosophy. Why concentrated portfolio? Why a large position size? Why will position sizing perhaps add value? It becomes far more about what stock are you picking, so on and so forth. So it was, I would say, it was a little incomplete. It was a bit more outcome oriented, and those elements, if we fix over a period of time, we might have done a better job, a much better job in ensuring that we are clear to the listener in terms of what we intend to do, so that the alignment of objectives, of interest, of expectations then becomes maybe a little better than what we did in the past, where we set the expectation in a very different way than what we were set out to do in the portfolio.
Amazing. So I think this is not a masterclass in investing, but it's a masterclass in resilience and clarity of thought. Nothing less than what I expected. Last parting question on a lighter note: if you were not to do active investing, what would you do?
I would teach my kids how to analyze great businesses.
Fair enough. Fair enough. No, sounds good. This has been fun and eye-opening, with a lot of degree of seriousness and depth. So thank you. Thanks for being candid, and I'm sure we'll have multiple more episodes. This is just the beginning. But thanks for your time, and thanks to all our listeners. Hope you enjoyed this.
Thank you, Pramod. Thank you, everyone.